On January 15, 2023, in the bustling financial district of New York City, a significant incident began to unfold within the operations of FinEdge Capital, a leading investment firm. FinEdge had established itself as a pioneer in the use of algorithm-driven trading strategies, utilizing a sophisticated AI-based algorithm designed to analyze vast amounts of historical market data to make rapid trading decisions. This algorithm aimed to enhance investment returns while minimizing risks, relying heavily on past performance metrics to predict future market movements. However, on this particular day, an unnoticed flaw within the algorithm began to cause concern. The predictive model had been inadvertently programmed to place greater weight on past performance indicators that correlated with only certain economic conditions, neglecting emerging variables such as inflation rates, changes in consumer sentiment, and geopolitical events that could influence market volatility. As a result, the algorithm was ill-equipped to respond adaptively to the rapidly changing financial landscape. At 10:15 a.m., the first technical failure became evident. An internal review of algorithm outputs revealed that trades executed based on the flawed predictions resulted in significant losses during the morning trading session. The algorithm miscalculated volatility indices, initiating a sell-off when it should have recognized an opportunity for investment. This misconfiguration stemmed from a shallow understanding of the economic indicators prevalent in the current market climate, specifically failing to account for inflationary trends that had escalated in the previous weeks. The immediate financial impact was palpable. Within the first 2 hours of trading, FinEdge Capital recorded losses exceeding $50 million as a direct result of the algorithmic trades. Concurrently, partner institutions utilizing similar algorithmic strategies began to suffer losses as well, their exposure compounding the crisis. By midday, market volatility escalated, with major indexes declining by over 3%. The downward trend triggered a cascading effect across numerous trading firms, erasing billions in combined market value. In total, preliminary estimates indicated that approximately $8 billion had evaporated from the securities market in under 4 hours. Internally, the reaction at FinEdge Capital was chaotic. Initial emails circulated rapidly among the risk management and IT teams as they sought explanations for the sudden downturn. Crisis channels were activated, and notifications were sent to the executive team, drawing attention away from other business functions. Confusion reigned as employees speculated on the cause, with many focusing on external market factors instead of the algorithm itself. The IT team initiated a review of the algorithm, but quickly faced challenges in pinpointing the precise nature of the malfunction. Some team members assumed that external factors had unexpectedly overtaken market dynamics, while others proposed that a technical glitch in the trading platform was to blame. Externally, early indicators of the crisis started appearing in various forms. Users began to report irregularities on trading platforms, with several clients expressing concerns over significant fluctuations in their portfolios. While these reports were initially treated as isolated incidents, the situation escalated with reports from brokerage firms that their systems were experiencing unusual trading patterns. Monitoring tools set to alert the firm of unusual market behaviors began triggering alarms as trades were executed in rapid succession, often contrary to the expected market trends. By the afternoon, minor media mentions began surfacing, focused mainly on the day's unusual market activity. Financial analysts speculated that a technical issue might be responsible for the additional volatility. some industry experts weighed in on the ramifications of algorithmic trading, drawing attention to the potential risks of relying heavily on automated decision-making without adequate oversight. As the financial day drew to a close, FinEdge Capital struggled to maintain comprehensive oversight of the algorithm's operational integrity. The decision was made to force a temporary halt to all algorithmic trading, allowing a thorough examination of the systems involved. Yet, as teams scrambled to debug and recalibrate the algorithm, signs of broader repercussions loomed on the horizon, prompting deeper concerns about the robustness of automated financial systems and their susceptibility to undetected biases. Unbeknownst to them, this incident was just the beginning of an escalating crisis that would have reverberations far beyond the walls of FinEdge Capital. As the evening closed in, the ramifications of the day's events unraveled further. By 5:30 p.m., updated reports indicated that losses across the financial sector had reached approximately $15 billion, with several major players now experiencing significant turbulence due to interlinked trading strategies. An emergency meeting was convened among executives at FinEdge Capital, where discussions turned heated as they weighed the implications of the algorithm's failures. Internal emails revealed a reluctance to disclose the full extent of the operational issues to stakeholders, primarily due to concerns regarding reputation management. Meanwhile, misinformation began to spread through the investment community. Whispers of an impending market collapse circulated in trading chats and forums, prompting a wave of panic selling as investors began to withdraw funds en masse. Social media platforms were flooded with posts about algorithmic malfunction and warnings of a market crash, feeding into the very volatility that was already gripping the industry. In response, other financial institutions, driven by fears of similar exposure, began rushing to temporarily suspend their algorithmic trading as a precautionary measure, which further exacerbated market instability. The following day, a more comprehensive investigation was initiated across multiple firms. FinEdge Capital, alongside its partner firms, engaged external cybersecurity experts to conduct an in-depth analysis of the algorithm. However, this would not quell the rising tide of concern. Reports surfaced that clients of FinEdge, as well as partner organizations, had suffered not just financial losses, but also systematic failures in their own operations, with users unable to access trading platforms continuously throughout the day. Within a week, the situation escalated to a national crisis level. Analysis revealed that numerous hedge funds and investment vehicles had become ensnared by similar flawed algorithms, propagating the damages through concentrated trading strategies. The combined financial loss across the sector climbed to approximately $30 billion, as regulators began to take notice of the unusual trading activities. Law enforcement was alerted, and an official investigation was launched by the Securities and Exchange Commission, SEC, into the practices of affected firms, examining not only the algorithmic strategies, but also the accountability of institutional leadership. By mid-month, FinEdge Capital's situation had further deteriorated. Legal notices began to flood in from investors alleging losses caused by negligence and misrepresentation of the algorithm's capabilities. Client sentiments soured, with many escalating their frustrations through social media, and demands for refunds became rampant. Consequently, the company instituted a temporary ban on all algorithmic trading. This was followed by a public acknowledgement of the failure on the firm's part to ensure robust risk management within their automated systems, which further undermined trust among both clients and peers. As financial bodies continued their scrutiny, regulatory authorities intervened with proposed reforms. Public hearings were announced to address the algorithmic trading landscape, focusing on regulatory gaps that had enabled such a massive oversight. Stakeholders from across the financial spectrum were summoned to present their experiences, and the stark realities of algorithmic biases became the central theme of the discussions. In parallel, the media intensified coverage of the ongoing crisis. Investigative journalists with access to whistleblower accounts disclosed internal communications that illustrated a pattern of oversight neglect and delayed warnings stemming from those who recognized the algorithm's limitations. Court filings and requests for audits surfaced, substantiating claims that key decision-makers at FinEdge had consciously ignored red flags raised by risk analysts during algorithm development phase discussions. As months progressed, mounting pressure culminated in widespread resignations. High-ranking executives, including the Chief Technology Officer and Chief Risk Officer at FinEdge Capital, stepped down amidst the public outcry and the growing scandal. Key testimonies during regulatory hearings shed light on the extent of the algorithmic reliance and the apparent lack of adequate fail-safes designed to counter unforeseen market shifts. By the end of the third month, the fallout had transformed into a legal and financial maelstrom. A growing list of class action lawsuits prompted settlements mounted against firms involved, leading to an estimated loss of an additional $5 billion in capital reserves. Ultimately, FinEdge Capital faced insolvency due to severed ties with major investors and funds, leading to a subsequent court-ordered restructuring and takeover by financial regulators. The firm's operations were dismantled, and algorithmic trading ceased as new policies were mandated for the financial technology sector. As media coverage waned, the reality of algorithmic bias remained embedded within the discourse of financial ethics and risk management. The market, although turbulent, began to stabilize, aided by emergency measures implemented by regulators aimed at establishing stringent oversight on algorithmic transactions. The final report, released by the SEC in December 2023, affirmed that the crisis stemming from algorithmic trading malfunctions led to unprecedented financial instability, exposing underlying vulnerabilities in automated trading systems. Subsequently, new legislative measures were proposed to enforce testing protocols and periodic audits of AI-driven financial models to prevent such occurrences in the future. On January 15, 2024, FinEdge Capital filed for bankruptcy following severe operational shutdowns and was placed into receivership. The consequences of this crisis resonated through the financial landscape, leading to a reformative pivot in regulatory practices concerning algorithmic trading. The incident would go down in history as a case study in institutional failure and the risks embedded within automated financial systems, marking a permanent shift in the operational doctrine of finance-driven technology.